Hello, everyone. Good morning. I'm Harrison Hong, Executive Director of the Program for Economic Research at the Economics Department of Columbia University. It's my pleasure to welcome you to our Zoom event on the rise of the retail investor, implications for policy and markets.
Sorry, guys, I'm a little bit late.
No problem, Jose. We are starting and we're recording live. As all of you probably have paid attention to in the last year, the confluence of social media and technology has led to this resurgence of retail investor trading in financial markets, whether it's speculation on meme stocks like GameStop or cryptocurrencies like Dogecoin. The goal of this event is to explore the use of big data regarding retail investor order flows to understand the implications of this resurgence for financial markets and also for regulators. The panel is a part of a series of events that we've been holding in conjunction with Capital Fund Management, a French hedge fund specializing in alternative data. So it's my pleasure then today to kind of introduce the panel. We'll feature a lecture by Charles Jones, my colleague, and the Robert Lear Professor of Finance and Economics at Columbia Business School. Before I introduce Charles, let me introduce Adam Rake, who represents CFM, for him to say a few words about the initiative. Adam?
Hi, hello everyone. CFM Per Alternative Data Initiative has been launched because of how important alternative data has become in investing and in economics. The joint initiative enables PhD students to use alternative data sets in their research projects and also provides a platform for cross-collaboration between academics and investment professionals. While many of the alternative data sets are novel and previously unexplored and very interesting, it is important to maintain the same high standards of academic rigor when examining their usefulness and explaining stock market or economic phenomena. The two groups of students that CFM has been hosting have by now completed their projects and they found interesting results. And together with Per, we are working towards launching a new call for proposals. So please stay tuned. Also, as a part of the CFM Per Alternative Data Initiative, we periodically organize seminars such as this one on data sets and research that seem particularly timely. And today's edition focuses on the rise of retail trading. So I'm looking forward to learning more about how retail trading impacts markets. Thank you, and over to you, Harrison.
Thanks, Adam. So our lecturer for this Zoom panel is Charles M. Jones, the Robert Lear Professor of Finance and Economics. Charles has been a leader in the field of market microstructure for a very long time. He's written some of the most important papers on high-frequency trading and shorting constraints and a number of other important topics in market microstructure, including information discovery. He's won Best Paper Awards in a number of our leading journals. He's been a member of the Economic Advisory Committee of FINRA and is head of the Economic Advisory Board at NASDAQ. So it's my pleasure to welcome Charles today. Thanks a lot for joining us, Charles, and the floor is yours.
Thank you very much, Harrison. It's a pleasure to be here, and I appreciate the invitation, and I'm looking forward to this. So let me get right started. So I have my title is basically the recent rise of retail investor activity and its consequences. And I want to talk about the rise of it and the implications for markets, but I also want to say a few words at the end about some of the policy implications of this, because I think there are important policy implications involved here. So let me get started. So unlike some countries, U.S. equity trading is still dominated by institutions. So it's very hard to get actual data on this, but we think that up through 2019, at least, individual investors were only responsible for about 10% of trading in our market, with institutions nearly all of the other 90%. This is very much in contrast with some other countries, notably mainland China, where it's sort of reversed. Like 75% of trading there is individual investors or retail investors, and institutions account for only a small part in that country. So there is a range of importance of retail investors. In this country, there are different ways to do retail equity trading, but if you're talking about direct retail equity trading in individual stocks, It's mostly happening through retail-oriented broker-dealers like Schwab, Fidelity, Vanguard, TD Ameritrade, Interactive Brokers, Robinhood, and other newer and generally smaller startups. And the most established larger players such as Schwab, Fidelity, and Vanguard tend to market to somewhat wealthier customers. And a notable exception to this is Robinhood, which is targeting younger millennials with less wealth and investing experience. So Robinhood has a very slick phone app and has recorded spectacular growth since it was founded in 2013 and formally introduced its app in 2015. It claims over 13 million customers as of 2020, which is similar to Charles Schwab, and assets under management are basically something like $20 billion at this point. So the nice thing about Robinhood is that it is sort of a large player already, although its AUM is definitely smaller than a company like Charles Schwab, because it's basically marketing to younger and less experienced and not as wealthy customers. But the thing about Robinhood is that it basically, its customers trade a whole lot. So, and its customers trade in a concentrated set of stocks. So it's actually very active in terms of the customers behind Robinhood. So it really is the high profile new entrant that is taking the place by storm. And in 2019, it made waves because it started a retail commission price war. Robinhood has always been commission free, zero commissions, but in October of 2019, virtually every other US retail-oriented broker had to match Robinhood's zero commission because they were worried about market share loss. So any online equity trades through any basically Schwab or Fidelity or any of the other players are now zero commissions. So, and Robinhood also offers zero commissions on options trades. Most other retail brokers, some of them have cut options commissions to zero as well, but most other retail brokerages have cut options commissions to 50 cents or so per contract. So there's been a huge price war among retail-oriented brokerages. So lower commissions plus the COVID-19 pandemic have basically sharply increased the market share of retail trading volume in 2020 and 2021. Again, there's sort of a lack of data in this whole space, but Citadel, an important intermediary in this space, estimates retail trading is now about 20% of equity volume in the US on average, and sometimes as high as 25%. So in the GameStop episode, for instance, which I'll talk about in a bit, those numbers went as high as 25% and even a little bit higher for a while because those stocks were really popular among Robinhood customers and they traded them like crazy. And they caused this sort of retail frenzy in terms of trading volume and a retail frenzy in terms of prices of some of these stocks. So what do we need to know about the I/O of retail order flow? Most retail orders do not get sent to any exchange at all. They're handled off exchange by an internalizing or a wholesaling broker who takes the other side of the retail order as a principal. And this broker often provides a small amount of price improvement so that the execution price is a little better than the prevailing national best bidder offer, which is the best prices being offered or bid in the market at a certain time. And so this price improvement is usually a small fraction of a cent. Common price improvement amounts are basically 1/10 of a cent, 2/10 of a cent, 1/4 of a cent, something like that. So it allows the broker to say you're getting a better price than the prevailing NBBO, but it still leaves, I think, some bid-ask spread for the internalizing or wholesaling broker. So they're not losing money on it, but they're actually providing a slightly better price than what might be offered to the customer otherwise. Now, like all transactions, off-exchange transactions must also be immediately reported to the consolidated tape of all executions. And usually these off-exchange transactions are reported via a separate avenue. It's a trade reporting facility operated by FINRA. It's called a TRF, and you usually see that right away. So it's not reported with any sort of delay, but it is reported by this separate channel. So these are marked with a separate exchange code, but you still get the price, time, and size of the trade immediately off of this. Now, I will say that most of these retail orders are in fact price improved. So this is a very standard process. So this comes from the Scottrade website. and shows you sort of what are the price improvement percentages during 2016. And for market orders in S&P 500 stocks, if it's under 2,000 shares, more than 95% of those orders are actually price improved. And if it's under 10,000 shares in an S&P 500 stock, more than 90% of those orders are in fact price improved. So like I said, the price improvements are small. They leave a little bit of profit for the internalizer or wholesaler, and different brokers do this in different ways. Some of them run an auction for each order that they get. Some of them basically make long-term arrangements to have all their order flow dealt with at a certain amount of price improvement. But the idea here is that price improvement is very, very common, and it happens in S&P 500 stocks. It's also very common in stocks that are not in the S&P 500. The only place it's not so common is in the most illiquid stocks. So lots of stocks basically regularly see this sort of price improvement. The other thing that has changed in the IO of the retail space is that now payment for order flow is very much part of the business model. Because they are not getting commissions, these commissions are essentially zero. So most retail brokers now sell their order flow to these wholesalers, and they receive a small amount of payment per share. This is a small amount of payment for order flow. And this is a really important source of revenue for these retail brokers now, because the commissions are zero. They only have 2 or 3 sources of revenue these days. And so this has become important. So they have to report their payment for order flow totals to the SEC on a regular basis, actually monthly. But for instance, some of these brokers make more on payment for order flow than other brokers. So for instance, Robinhood reported $682 million in payment for order flow. And that was a year-on-year increase of 514%. So I would say Robinhood is really the top of the heap in terms of how much they make on payment for order flow. So this is a huge source of revenue for them. Schwab, for instance, reported just $244 million in payment for order flow in 2020, even though their assets under management are on the order of trillions rather than millions of dollars. So why does Robinhood make more? First of all, their customers trade a lot more, and in part, Robinhood's making more on this because it's actually selling its order flow at higher prices. They've actually gotten in trouble for the high revenue that they've gotten from their payment for order flow. So they've entered into a settlement with the SEC, and they entered into an arrangement with FINRA whereby they had to pay a penalty on the amount of payment for order flow that they got. And I will say that from a policy point of view, and I'll come back to this at the end, the SEC is very uncomfortable with payment for order flow. They've always sort of reluctantly allowed it. And in fact, under the new chair, Gary Gensler, they've promised to look at this closely to see whether this makes sense. So the idea behind payment for order flow is that as long as the customer is getting something in return for this payment for order flow that the broker is getting, then the SEC is sort of comfortable with that if it's sort of a fair trade in terms of, the broker's getting something and the customer is getting something, probably in the form of lower commissions or something like that, and that the SEC would be fine with that. The SEC is just concerned that it's become sort of unbalanced and that the brokers are making money on the payment for order flow, and now that the commissions are zero, it's not clear what the customers are getting in return for that payment for order flow. So this is an issue that's definitely on the regulatory calendar and the regulatory radar right now. Now, I will say something next about how these things are actually ordered. So like I said, these things are not sent to an exchange, but they're executed off exchange. So, and usually with a little bit of price improvement of a fractional amount of cents. So institutional order executions do not get these sub-penny price improvements. So they don't get these small fractional cents of better prices. And why is that? Well, Reg NMS, which was put into place in the mid-2000s, prohibits orders from having a sub-penny limit prices. So as long as you are putting in a limit price, your limit price has to be a round penny. So that's quite limits how much you can do at a sub-penny limit, at a sub-penny price. has to be a marketable order that that is then being executed at a fractional price. The one place where you can see prices that are not round pennies is there. You're allowed to actually, Reg NMS allows executions at the quote midpoint. So institutions often use crossing networks or midpoint peg orders that generate transactions at the midpoint price. And since the quoted spread is typically about a penny for most stocks these days, there are a lot of transactions reported at a half penny. So, so you can actually see lots of midpoint prices that are executed at a half penny in addition to executions at a round penny. But if you see prices that are sort of not at the midpoint, not at a half penny, those are probably retail orders that are being internalized or wholesaled in this way. So why does that matter? Well, in fact, what we do in a paper that's coming out in the Journal of Finance that's called Tracking Retail Investor Activity that I've written with Eckert Gomer, Xiaoyan Zhang, and Xinran Zhang, is that we have this algorithm, which we call BJAS, and it says basically if something gets sent to the FINRA TRF, which is off exchange, then basically if you count the fraction of a penny that's associated with the transaction price, if it's somewhere just above the round penny, then it's probably a seller initiated retail trade. And if it's just below the round penny, it's probably a retail buy order that is executed off exchange with a wholesaler or internalizer. So we're able to sign the trade as being initiated by a seller or initiated by a buyer. And if it's at the round penny or basically near the half penny or right at the half penny, then we don't assign it to the retail category. And for sure, we are definitely missing some retail trades because we're sure that some retail trades are actually executed. They don't get price improvement or they get a half cent of price improvement. So we're not trying to assert that we get all the retail trades by doing this, but we think we're getting a large fraction of them. And the point is that we don't have any type 2 errors. So everything that we think we're getting is in fact retail, and we think we're signing it correctly. I'll come back to why we think we're signing it correctly in just a second. So just so you can see a picture of what this looks like. So there's a huge number of trades at the round penny. Those things would be off the screen if I actually gave you the right scale for the number of, this is the number of Microsoft prints in a particular week from 2015. And you can see there are a huge number of the round penny. They're not recorded here. And there are a huge number at the half penny that we would not assign to the retail category. But you can see there are plenty of trades that are, getting a price improvement of 1/10 of a cent or 2/10 of a cent or something like that. And that we can assign those as either retail sales or retail buyer initiated trades. And then to validate this, we have some proprietary data from NASDAQ, which is all intraday transactions on its TRF for 100 stocks during October 2010, for which we thank Frank Hathaway, who was the chief economist at the NASDAQ at the time, and Albert Menkfell and Haosheng Zhu. And so we actually check whether we get the sign of the trade correctly. And for stocks that are below 100, which are stocks where the spread is probably about a cent for most stocks, we get the buy sell sign right about 98.2% of the time. So this is very accurate in terms of signing trades that are coming from retail investors as either buyer initiated or seller initiated, which actually is really important because we're going to look next to see whether these trades are actually informed, whether these trades actually have some information about future price moves in the cross section of stocks. And we find that they do. So this is actually a big debate as to whether retail trades are informed at all or whether they're just totally uninformed, and whether the traders who are behind these trades are making behavioral mistakes or otherwise not trading in a way that makes sense in terms of information. So what are we doing here? Just to give you a little more information on the data we're using, we're excluding the trades at around penny because we think these are we think this is more likely to be institutional, and we're trying to exclude also the limit orders because the limit orders have to the prices on those limit orders have to meet the minimum price increment rules, so they cannot have fractional pennies in them at all. So we're basically dealing with just common stocks here, and we're removing low price stocks because minimum ticks are very different for stocks with a share price below $1. And we've got about 6 years of data here. So, and each day we have about 3,200 firms in the sample. So that's what we're going to work with to see whether there's information in this retail order flow. So like I said, I'm not making a claim to actually capturing anything close to all the marketable retail order flow. All I can tell you is that 90% of this marketable retail order flow that's sent to retail-oriented brokerages is actually price improved. We think we're capturing a majority of this marketable flow, but we cannot know for sure. And we start in 2010 because we think it took a while. NMS came into effect before right about 2006. And so we think that basically it took a little while for these price improvement arrangements to become stable and for retail-oriented traders to send their order flow to these internalizers and wholesalers. But we don't think that we can use our algorithm before 2006 or outside the US regulatory context, because the US regulatory context is somewhat unique in terms of how it treats retail order flow. So that's why we're focusing on this. If you have older data and you want to try to identify retail order flow, most people suggest that you use trade size. But trade size has become a very poor proxy for retail order flow because it's really reversed. Now, retail order flow is actually larger in terms of average trade size than institutional order flow because the institutions are slicing and dicing their order flow into very small pieces. And the average trade size is now like 100 shares for institutional order flow. It's actually larger. It's actually more like 200 or 300 shares for retail order flow. So that particular way of identifying retail order flow is totally useless now. So, and why do we stop in 2015? Because the SEC started a mandated tick size pilot because they thought that a penny was maybe too narrow for a minimum tick. And so they wanted to experiment with a larger minimum tick, particularly for stocks that were less liquid. So they started that in 2016 and it ran for 2 years. And so that what it did was increase the minimum tick. It increased the minimum tick. Somebody is on echo a little bit. So in 2016, they forced a lot of these illiquid stocks to have a nickel tick, a 5-cent tick. And it turned out to be terrible for market quality. Market quality got worse under the tick size pilot. So they quit it as soon as they could and went back to the penny tick. So, so just so you can see here, these retail orders tend to be fairly good size. So the interquartile range is quite large for these things. And order sizes for retail order flow are fairly good size. So this is just showing you what I said about the fact that that trade size is no longer a good proxy for retail order flow. And this is basically, I showed you the proof by observation about the distribution of share volumes across subpennies. And this one actually includes the round penny. So you can see how the round pennies are a huge fraction of overall trades. And the half penny is the second biggest, but you have quite a few trades that are at these fractional subpenny improvements, and they're receiving this from the internalizer or the wholesaler. And so those are the ones that we're going to focus on here because those are clearly the slightly price improved retail orders. So I can show you some of the data here. We're working with a very large data set here. 6 years of data gives us about 4.6 million trades of different sizes. And you can see here what the order imbalances look like for these retail trades. So some of the stocks are dominated by sells, and some of the stocks are dominated by buys, but there's obviously quite a bit of cross-sectional variation and time series variation in both of these. So these are all daily or weekly observations. So you can see you getting into the realm of big data, even though what we have here is not really using intraday data except to identify particular trades that are either buys or sells by these retail investors. So what are we going to do with this? Once we really think this paper is about the algorithm to identify retail trades and to sign them as either buyer or seller. But once you have that signing technique, once you have that algorithm in place, then you can do all sorts of interesting things with it. So what we do with it is basically see whether order imbalances by these retail investors can help predict next week's returns. So we want to see whether these C1 coefficients are positive. So if the C1 coefficients are positive, then we're predicting the cross-section of returns, and a bunch of buys by these retail investors predict a price rise in the next week. So why do we think this is important? Well, there's a sort of debate in the literature about what it has shown about retail investors in the past. So the existing evidence is really mixed. It does seem like some of the older evidence says they make a bunch of behavioral mistakes and they don't seem to have much information. So that's sort of the early Barber and Odin evidence, which actually uses a retail brokerage and retail brokerage trades from the 90s. And then the more recent evidence suggests that these guys do seem to know something and that they have private information, and that's eventually reflected in prices after they trade. So what do we estimate here is weekly Fama-Macbeth regressions to see if we can predict the cross-section of next week's returns with the retail order imbalances from this week. And what do we find? We actually find big T statistics and big predictability in the next week. So if you look at, we have T statistics that are 15 or 16, and we have economic magnitudes that are pretty large too. So if you go from the interquartile range and see what the return difference is for the next week, the return difference in the next week is about 0.1%. So if you annualize that, that says that basically there's about 5% of alpha in a year annualized in these weekly order imbalances by retail investors. So I would not say this is not as huge as what we found in our shorting papers. So short sellers seem to have more private information than retail investors, but retail investors seem to have about 5% a year in terms of private information. And so I would say that's not zero, and suggests that there's at least some evidence that there's a decent amount of private information floating out there from these retail investors. So I would say that we basically find results that are not consistent with the early Barber and Odin, and are more consistent with the most recent data by Kelly and Tetlock and some folks, David Strayer and co-authors on European data. So it appears that these guys do seem to know something, and they trade on that, and they at least seem to make money in terms of at least pre-trading cost, in terms of making extra alpha from their information and from their trading volume. And when we actually divide this up into different subgroups, you won't be surprised to learn that the smaller the stock, the more information is in that, and the larger the stock, the less information is in that retail trade. So we find that small cap stocks have a lot of information in it, so about double the overall sample means, and low price stocks seem to have more information in it, and low turnover stocks seem to have more information in it. So those are the three groups, but even the largest stocks, even the highest price stocks, even the highest turnover stocks do have significant, and nothing close to 2 here. These sort of beat any sort of critical T-stat that you might impose. So this appears to be a persistent feature of the data. So the question is, what are the horizons here? Is this a transient predictive relationship, or is it something more persistent? So what we can do is basically predict K week ahead returns. So how long does this last before it dies out? If it's a short-lived thing, it might only last a week or so, or maybe a few days, and it might be longer horizon in terms of its predictability. So what we find is that it's basically decaying at sort of a reasonable rate that might be consistent with sort of calendar time fundamental information or quarterly information, so that it goes down, it decays sort of exponentially, and it's there at least reliably through 6 weeks, and then it's sort of dying off to zero after that. So not too surprising. So the next thing we look at is whether this is persistent if you look in terms of long-short portfolios rather than Fama-Macbeth regressions. And so what do we find here? We look at raw returns. We also look at risk-adjusted returns using Fama-French 3-factor models. And again, what we find there is that the biggest results are in the small stocks, and everything decays, but the small stocks, in particular, the small stock alphas, are decaying quite slowly, and the big stuff alphas are decaying considerably faster than that. But it's there. It's not just a feature of the Thoma-Macbeth weighting scheme, but this is also there when you evaluate long-short portfolios and you try to think about whether you could use that information to form a portfolio that might make you money at least before you think about transaction costs. And then I will say another thing that we do is to see whether odd lots have the same kind of information. So odd lots are trades of less than 100 shares, and we find much less information in odd lots. In fact, that's where we started in this paper. We started thinking about whether there was any information in odd lots, and we really don't find that there's much information in odd lots. So it's only the larger retail trades that seem to have information behind them. So I don't know if that says that these small traders are maybe more subject to these behavioral biases, or if they're just trading and they just simply don't have any information. So they sort of make what the market would make and nothing more, nothing less than that. So anyway, we find that to be sort of interesting. The next thing we do is to see whether small trades have more information in them than large trades. And what we find is that actually the large trades do have more information in them. So trades of more than 400 shares seem to have sort of double the amount of information and corresponding T statistics than the small trades that are less than 400 shares. So we do find some evidence that trade size still matters, but it's not the same as, we don't think it's a good proxy for whether you've got a retail trade or not, but it does seem to be a good proxy for the quantity of information that you are trading on. And if you are getting less price improvement, you're more informed than if you're getting more price improvement, because essentially the broker, the internalizing or wholesaling broker, is only going to give you as much price improvement as he can afford. So if he's giving you more price improvement, it probably means that you are more informed and this broker has to be careful about how much to give out. So if I summarize this BJAS paper, again, it's really about the algorithm, and what we can really use this fractional penny price improvement to identify a lot of this marketable retail order flow, and then basically identify it as seller initiated or buyer initiated. And what we think is great about this algorithm is there are a huge number of applications for it. We've found already that it's gotten a bunch of Google sites, and it's really gotten a bunch of Google sites from, mainly the first place it's gotten them is from the accountants who want to use this to think about earnings announcements and reactions to earnings announcements and other fundamental information releases. And so we think there's, especially since retail trading has surged recently, we think there are a lot more things you could use this on. And so we're trying to encourage people to use it wherever they can think about applications for it. Then a second paper I want to talk about briefly is a paper that I have with Will Waller and Adam Reed that basically is when brokerages restrict trading, does the game stop? So there was a notable episode back in January in about 50 stocks, which have been called meme stocks. And these 50 stocks are popular with Robinhood investors. Robinhood investors tend to concentrate their trading in a small amount of stocks. So if you take the top 10 traded stocks by Robinhood investors, that accounts for more than a third of their trading. So they're concentrating in certain stocks that appeal to them. And these were prominent on the subreddit forum, Wall Street Bets, which is a part of Reddit, which is a social media platform. And these things rose sharply in price in late January, notably GameStop, which is a bricks and mortar video game company, which sharply divided analyst opinions and high short interest. A lot of the shorts thought that the future of video games was in online sales, not in bricks and mortar sales. But what ended up happening is all this volatility led to a huge capital call from Robinhood's clearinghouse. And so Robinhood responded to this huge capital call by essentially restricting new positions and increases in equity positions in several stocks, including GME. And the restrictions got less severe over time, and they only lasted for a total of about a week, but they were serious while they were in effect. And so when investors cannot buy a stock, which is what happened here in GME and about 10 other stocks, what ended up happening, you won't be surprised that if investors cannot buy, they will fall sharply in price because who's left is just sellers. So how much does it fall? Well, here's the picture that tells you that essentially that after about a week of this, the stocks fall by have cumulative abnormal returns of about minus 50%. So it's a huge share price fall in these stocks that have these trading restrictions imposed. And the restrictions start very quickly. So within 2 hours, you've already got CARs that are about minus 10%. And it doesn't take long for them to go a lot bigger. And the other interesting thing is that when the restrictions are later lifted, they don't rebound in price at all. They continue to stay at these lower levels after the trading restrictions are relaxed, which we think is important. The other important finding that I want to mention is that there's a big substitution from equities to options. So there are big increases in option open interest and option volumes in the restricted stocks. So, and there are also big increases in option prices as measured by implied vols and by implied vols less realized vols. So these substitution effects are very different from those found by Rob Battaglio and Paul Schultz, who studied the 2008 US short sale ban in financial stocks, which lasted, about 3 weeks in those stocks. And they found very little substitution into the options markets, and basically said that people just stopped trading these financial stocks while the short sale ban was in effect. So our results are very different from their results because we find huge substitution effects into the options from the restricted equities. And so this also, because there are these big increases in option prices, and because these implied vols are much bigger than the realized vols, what it says is that they're moving heavily into options and wildly overpaying to buy these options. So this is basically a huge transfer of wealth from option buyers, mostly retail option buyers, we think, because this is concentrated in Robinhood investors. And so they're way overpaying for these options. So they're causing big transfers from the option buyers to the option sellers. And who are the option sellers? Mostly these would be options market makers who are taking the other side of these trades and basically getting paid very handsomely to take the other sides of these trades. So that's a very novel result and very different from what people have found in the literature before. So we think that's a big, yep.
You have 5 minutes.
Thank you. I should have no trouble with that. So the options were already expensive in these stocks, and they got a lot more expensive here. So if you look at, this is basically event time implies minus realized volatility. And you see that basically when these restrictions went into place, you see that essentially these implied volatilities got 15 or 20 percentage points above realized volatilities in terms of annualized vols. And so this is just think about this as the P measure about what about how much implieds would be actuarially unfair relative to the realized volume. So these things are sort of being priced at 15 to 20 annualized percentage points above their fair value. And that's relative to 0 beforehand. So these things got wildly expensive. And I should also say that, for instance, GameStop implied vols were already above 100% on an annualized basis. So they were already very expensive, and they suddenly got actuarially much more expensive. And so that is another way of suggesting that these people are really overpaying to buy these options during this episode. And then let me say a few words about the regulatory angles here about payment for order flow. So like I said, the SEC is looking carefully at this. And the real big issue for them and for the new chair, Gary Gensler, who's come in and said this is going to be a priority for him. And that payment for order flow is essentially whether retail investors are getting something in return for the payment for order flow that the brokers are actually earning from selling these things. So it's well known that Robinhood sells most of its order flow to these intermediaries. They are high frequency traders. They're companies like Citadel Securities and Virtu and other intermediaries that are willing to handle this order flow that comes in return for some payment. And so I think the real question is whether the retail investors are getting something in return for the sale of this order flow, or whether this is simply a way for Robinhood and other retail-oriented brokerage firms to actually get some revenue out of this order flow in some way, shape, or form. So this really gets to the question of best execution and whether retail order flow is getting that best execution in some way, shape, or form. So it really speaks to the requirements of brokers to deal with their order flow in a way that doesn't disadvantage their customers in any particular way. So I think it will be interesting to see what happens. My guess is we're going to see roundtables and all sorts of people weighing in with comment letters, and there will be proposals that will come out of the SEC that will address this, that will address these aspects of payment for order flow. I have always been uncomfortable with payment for order flow myself, so I wouldn't be at all unhappy if it went completely away. I think it will reduce a bunch of the conflicts of interest that are naturally inherent between brokers and their customers when dealing with this order flow. And that's not clear to me. I think you can obviously make a case that it can be done correctly, but I just think it has so much potential for misuse and conflicts of interest that I think we could get rid of it, and we would have a system that worked pretty well. So that's a little bit of editorial comment in there, but for sure we're definitely going to be dealing with this going forward. So let me conclude. So the conclusion of this particular paper is that this was an important high-profile episode that basically highlighted the increasing influence of retail investors, and basically these brokerage trading restrictions at Robinhood and other retail-oriented brokerage firms, particularly the ones that are brand new and targeted toward younger investors. They cause big negative share price effects and big substitutions into options with huge corresponding price increases in those options. And I think this highlights the increasing influence of retail investors overall, especially in 2020, 2021 during this pandemic. So I think that basically the message I want to leave is that these retail investors are actually really important to markets these days. And if you ignore them in your research and you're relying on identifying some of these investors, you need to keep these investors in mind as you design your research and design your specifications. And my last sort of postscript to this is that I don't think the GME episode, the GameStop episode, is not finished, in my opinion. So there are no more trading restrictions, but there was a second wave of share price rises in spring 2021 in March, and there were some associated margin increases due to the higher volatility. So I think we may be getting a second wave of a retail frenzy in these stocks. And I think it remains to be seen where that leaves us. GameStop, for instance, has gone back to $200 a share. And so that's not quite as high as it went in January, but it is still quite high. So I think that we're in for another episode of volatility, and I don't think we'll see trading restrictions, but I think that it's pretty clear that these retail investors are actually starting to have an influence on overall prices. So I will leave it there, and I will turn it back to Harrison, who I think is going to introduce Jose, who's going to moderate the panel.
Charles, thanks so much. Thanks for that excellent lecture. Really appreciate it. I wanted to, before I introduce Jose, just to remind everyone in the audience to use the Q&A function. If you have questions for Charles, just use the Q&A function, and we'll sort of gather those, and that will kind of form the basis of our panel discussion as well.
Also, if you have questions for the panelists, I think the same thing would be applicable. So,
absolutely. So let me introduce my colleague Jose Schenkman, who will now moderate, introduce the panelists and moderate the panel, and handle the rest of the Zoom session. Jose, the floor is yours.
Thank you, Harrison. It's a pleasure. First of all, I want to thank Charles for a very, very informative lecture. You know, I confess with many surprising results. I think that that these are more, you know, I was more surprised by some of these results because I was being informed by the earlier literature, and I think I think it's a very, I'm very happy that to hear these results. I'm having a little bit of trouble opening. I had a problem with my opening the file with the panel members.
Let me do
Harrison,
that.
would you mind introduce them? Yeah, because I'm having
Let
a
me do
little
that.
bit of trouble opening the file.
No problem.
Sometimes on my computer.
Yeah, let me do that. So we have three distinguished panelists. Our first panelist is Xing Huang. Xing is an assistant professor at the Washington University, and she works on a number of topics, including market microstructure and behavioral finance. Our second speaker is, our second panelist is Laurent Lalou. Sorry if I'm pronouncing your name wrong, Laurent. Thank you. Laurent is a member of the CFM and plays an important role in terms of a number of their quantitative strategies. And then finally, our third panelist is Rani Sadkar. Rani is Senior Associate Dean for Faculty and Professor of Finance at Boston College at the Carroll School of Management. Rani has also written quite extensively on a number of these topics as well. And it's thank you so much to all three of you for joining us. So Jose, let's start. I guess I think the ordering was going to be each of the panelists will get sort of 5 to 7 minutes. They can share their slides, kind of round out our discussion, round out the lecture, and then basically Jose will moderate and take any kind of Q&A questions from the audience.
Right, but I would introduce an initial question, right? So that an initial question. So I'm sorry for all the problems I've had with my computer today. For some reason, my video wasn't showing. There's something wrong with my desktop. So, you know, one of the things that interests economists in general is the idea that shorting is a mechanism to tame speculative episodes. Harrison has written on the topic, sometimes with me. And although it's not a novelty, you know, short squeezes after on meme stocks has increased, I think, in my opinion, the risk for arbitrageurs of suffering a short squeeze. You know, one of the interesting examples for me, in fact, has to do with GameStop. One of the big losers was a fund which was essentially owned by Steve Cohen, who lost about $2.5 billion. And Steve Cohen lost about $250 million on the last big short squeeze that were a lot talked about, which was the Volkswagen versus Porsche. So it is not that the short squeeze is a novelty, but but people seem to be perceiving them as a higher risk. So I'd like to hear from you a little bit, what is the impact of this new risk on the activities of arbitrageurs?
So Xing, you want to start?
So, yeah.
Right. So we should focus on this question first, or we will go with like the 5 or 7 minutes.
You know, you can kind of blend it in. Yeah, you can just kind of, you know, give your thoughts. And
Yeah.
kind of talk a little bit about your
So I did prepare some of the slides, talk a little bit about my research related to Robinhood, and I do think it relates a lot with the question as well. And I will also talk about like
Sure.
GameStop. I don't know whether that fits
Go
into
ahead.
the discussion.
That's good.
Okay, great. I hope the slides sharing is working okay and the Sunday is working okay.
It's good.
Thank you so much. Yes, thank you so much for Jose's question and wonderful introduction. And also thank Harrison for inviting me to participate in this amazing series. And I actually think Charles, and thanks Charles for the fantastic lecture. I think he actually sets a very nice stage for me to motivate like some recent project we've been working on related to Robinhood. And I wanted to talk a little bit about the paper, of course, with Brett Barber, Terrell Dean, and also Chris Schwartz. And even though like GameStop, a lot of people talk about short squeeze, and we do think the Robinhood herding episode is actually contributed a lot to the amplification system as well. And I want to talk a little bit about like the Robinhood side and also link to the GameStop, and hopefully also answer Jose's question. So we all know that stock market non-participation puzzle in this literature, and Robinhood like cleverly solved this puzzle by reducing both like financial costs and also cognitive costs, and attracted like much more people start trading. And of course, there are a lot of changes in how people trade, and Charles also mentioned like some dramatic changes in this investment landscape. So this leads us to think about like how would these changes actually affect investors' behavior, especially like whether Robinhood investor behavior different from general retail investors, and what are the implications for the financial markets. So to answer these questions, of course, we need to look at some data. And Robinhood, they made their user position data available for a 2-year period, which is great. And we can use that to proxy for the Robinhood investors trading. And of course, to understand Robinhood, we also need to think about the benchmark. So Charles was saying to encourage people to use their measure. So basically their measure is perfect for that. And we use the tech data to proxy for the general retail investors trades. So we actually looked at a series of investors' behavior between Robinhood versus tech, and most of them look pretty similar. But one thing really stood out is how much more concentrated Robinhood trading activities are compared to the general retail investors. And what kind of stocks are they concentrated on? So here we can look at like their platform outage. So the general idea is that when Robinhood investors, they cannot trade during the outage, but then the market is still open, how much would their total retail trading drop? So for the average stock, the total retail percentage drops by 6%, but then this drop is much more for Robinhood most popular stocks as well as the high attention stocks. So from here, we can see the Robinhood investors, their trades are disproportionately concentrated, and it seems like their trading are attention driven. So of course, the next natural question is to think about what actually explains this concentrated trading. So a few possible candidates here. So the first one can be clientele. Charles also mentioned the Robinhood investors, they are very young, they're naive, and they're first-time investors. So they're likely to think and trade in the same way, and that can lead to concentrated trading. And the second one is the social media, and we all see how that played out in the GameStop frenzy. And the last one we focus a little more, which we also want to mention because it's quite subtle, is the coordinated attention by the simplistic design of the Robinhood app. So they provide a lot of exciting things on their platform, like the top mover list, the popularity list, and they also make things very intuitive, which only keeps the bare minimum. So if you go to a traditional brokerage app, you may get overwhelmed, but then on Robinhood, you don't see a lot of things. The few things you see actually become very salient. And that can also coordinate investors' choice sets, and then that can lead to coordinated buying behavior. And we think the coordinated buying behavior is a very important thing because it has huge market impact, and that's probably play a role in amplifying the GameStop frenzy. So the hypothesis would be the coordinated behavior create herding episodes, and then that creates price pressure. And then subsequently, we will see negative abnormal returns. And we can see if we look at all the herding events, there is a huge price pressure beforehand, and then followed by a sharp turn of the negative return afterwards. So after 1 day, the negative return is already 1%. After 5 days, this reaches about 4%, which is huge. And this kind of different from what Charles just mentioned, the tag order imbalance actually positively predict future return. And after controlling for that, the result is still pretty robust. Just to give you some concrete example for the herding episodes. So last year we see some dramatic events like the herds and Kodak, but nothing compares to GameStop frenzy we see this year. And as I mentioned, the media mostly focus on short squeeze and predatory trading, but then we suspect the Robinhood herding episodes also contributed a lot to the amplification of the ramp up. So how do we know that? So this event actually is not in our sample, but then we can look at some other data like the Robinhood app downloads. So if you look at the gray bars, that is the Robinhood app downloads, and the historical high happened on January 29th. This is the Friday of that crazy week. And after that day, all this meme stock actually jumped to the top of the popularity list on Robinhood. So that suggests
Hi,
that—
Xing, can you close
Yes.
in a minute? Thank you.
Yes, sure. That actually says that Robinhood users, they bought these stocks, and we would expect the price crashed afterwards. So since then, as Charles also mentioned, GameStop actually has some other wild rides, but then it's not overlapped with the Robinhood app downloads anymore. But looking at this, you may also be curious what actually drive these two peaks of the Robinhood app downloads in April and May. So I will give you 3 seconds to form a guess in your mind before I reveal the answer. So are you guys ready? 1, 2, 3. Of course, it's Dogecoin. So maybe I should just wrap up. One thing I do want to mention, this kind of herding episodes and also the negative return is not a specific phenomenon for the pandemic, because even before the pandemic, this pricing factor is also pretty strong. So I will skip some of the implications for individual investors, just to wrap up here. So this is just like one angle we look at Robinhood data and to talk about their herding behavior and its market impact. And certainly I think it matters much more now when we think about the short selling and also the constraints for short selling. And certainly we are not the only one who's interested in this. I think Charles just mentioned their paper, and Ronnie also had a wonderful paper on this as well. So I personally think this is a fascinating topic to think about evolving role of retail investors in the market. I hope that's kind of answered Jose's question, and look forward to more discussion later on. And thank you.
Hi, thank you. Thank you very much, Xing. I think our next panelist will be Ronnie Sadka. You have the same 5 to 7 minutes. Thank you, Ronnie.
All right. Thank you very much. It's a pleasure being here. Charles, great presentation. Xing, I like your work as well. Obviously, we're in the same area. In the interest of time, I really want to mention, I have 2 comments that I'd like to make over my presentation related to retail investors. One is I want to talk about what retail investors did during the early days of the pandemic. And the other is I'm going to talk about a little bit more about the meme stocks and the social short squeeze that happened earlier this year. I think retail investor, we talked about this, that it's been a long puzzle, why retail investors are not enough in the market and do not participate enough. People talked about that. Now this seems to be participating a lot. What's different now? I think there's a few things that are different. First, they have access to fintech technology. They have access to trading platforms, very low cost. They can participate, but there's another difference that now they can actually coordinate. So not only participating on platforms like Robinhood with very low cost, but they can also coordinate on social platforms like Reddit, and that could create some consequences. So I want to talk about, again, the two. First, I'm going to talk about liquidity. I think the early days of the pandemic with the lockdown in the United States really gave us a really interesting setting that we can study retail investors. What you see here in the figure, and all of these results in the first part of this talk, of this comments, is really on the paper we published now, or it's forthcoming at the Journal of Financial Quantitative Analysis. And so if you want to look at tables, they're there. So these are just a few figures. What you can see here is, and the bars are the mobility index. So Apple has a mobility index. They started that in January 2020, really opportune time. And then you can see how mobility was pretty high. It crashed around March 15 when the United States had some lockdown. And then after that, there's a reopening period where mobility picks back up. And this line here that you see, the line is the media coverage on COVID-19. The media coverage of COVID-19 was about 75% of all media coverage on equities was pertaining to COVID-19. I'm not going to really emphasize so much this in my talk, but it seems that retail investors respond quite significantly to media coverage. So what happened during this time when people were at home? What happened was they jumped in and provide liquidity. So when you just take a look at what happened in the market in the last, let's look at first on the two panels on the right-hand side. The top one is the financial crisis. Remember that, 2008, daily data. The bars are the average effective spreads for S&P 5, and the continuous line here is the level of the S&P 500 index. And you can see it's there's a shock, there's a liquidity shock happening there, but there's multiple shocks throughout the next several months. We know the market only picked up in March 2009. That looks very different from the figure below, which is what happened during the pandemic. There was really one illiquidity shock happening on the Friday, March 20th. The market dropped until then, and after that, from that was the minimum point, and after that it started going up. So these are very, very different. And the reason I think they're different is because retail traders came in and provided liquidity at the time that it was the most needed. So the graph on the left, the continuous line here is the number of trading accounts, unique trading accounts on Robinhood. And you can see how it increases from 2020. It accelerates in the increase during the lockdown. The bars that you see here are the net outflow from U.S. mutual funds. So there seems to be some kind of substitution effect from delegated to indirect, to direct investment. So in the paper, I don't have time to show it now, but in the paper, we demonstrate that indeed what happened is these retail investors came in and provided liquidity. When you compare high retail investment in traded stocks versus low retail traded stocks, the difference in their illiquidity is about 40%. So it's true that overall liquidity was worsened during the pandemic, but when you compare cross-sectionally between firms, those that were more heavily traded by retail investors had much more liquidity. To identify that, again, I don't have time, but I just want to explain the setting, because people can say, well, there's just correlation, it's not causality, it's a bunch of economists here, need to be careful, identification mechanism. So what we want to avoid this kind of reverse causality, that maybe retail traders saw the asset as liquid, then they traded it. So to identify, we used the staggered implementation of lockdown in US states. What you see in the figure, the horizontally is just the calendar dates, March 14, 15, 16. And then vertically, you see the states that went into lockdown. The first one to go into lockdown was Puerto Rico, followed California, Illinois, etc. So you can see every day there's other states that go into lockdown. And what we do is we use that variation. Okay, so we have firm day state variation to identify that indeed investors, retail investors, when the lockdown was implemented geographically in their state, there were more searches on Google originating from that state on the assets on, for example, the stocks that are headquartered in that state. So at the end of the day, what we find, we kind of have this evidence of home bias, but we do find that stocks headquartered in states that are under lockdown, okay, the searches, Google searches on these stocks generated more liquidity for these stocks. So you look at the paper, but that's a little bit about the identification. I do think that what happened is they came in. It's a positive thing that retail investors were able to get into the market and they traded. We didn't have any other intervention in the equity market. The second point that I want to make is—
Only 1 minute. Can you close in 1 minute? Thank you.
Yes, thank you. The overlooked risk of short squeeze. We talked about that. We looked at the social media. We looked at Reddit, and we looked at there's about 9 million posts up until leading up to the GameStop short squeeze. And what we saw is that there's high intensity of coverage of short squeeze on the meme stocks. And this is what you see here is GameStop, 2 weeks even before the general media picked it up. So it was highly covered in social media. In I guess the only, you couldn't see it if you weren't looking at Reddit, you didn't know that. Now, in the analysis of Reddit, what we did do is we looked at, instead of NLP, we can throw all of that out, all this natural language processing, we have to do emoji analysis. We realized that people are, the way it works on social media is they say, we don't like the CEO, rocket, rocket, never selling, rocket, 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 moon. So this is, YOLO, YOLO, this is what people, how they communicate there. We count the number of these emojis and we can identify who's more in the social media and who's less in the social media. And when you look at that, I think you find two interesting results. I'll just say it quickly. What you see here is short interest. All these points are stocks that have high short interest. And what you see here is their sentiment on social media. The high short interest stocks are precisely those that retail investors are very positive about that. That's the short squeeze, the short squeeze risk. And if you just look at the top, let's say, top 100 social media, meme stocks, and look at what Charles did, you can look at their outperformance. Just, I don't know how to think about this, whether it's risk or some kind of behavioral thing, but the meme stocks do seem to outperform the index over the last 6 months or so. So just to conclude, I wanted to share just two things. One is I think retail investors had a significant impact during the early days of the pandemic. They provide liquidity. On the other hand, they also present some sort of risk. I agree with Charles and with Jose, what you mentioned about short squeeze of, the risk of short squeeze is now probably going to have some large institutions out of the market. You're going to have less forces of arbitrage because they're just worried about these stocks. And I think if you're a large institution, what you want is to try and understand which stocks in social media and try to avoid these stocks because of the risk of being squeezed.
Thank you, Ronnie. Our last speaker is Laurent Madou, who is the Chief Product Officer at CFM. Thank you, Laurent.
Thank you, Jose. So I'll be the practitioner in the room and try to share with you a few remarks about what we've experienced and what we've been trying to do. But first, I would like to thank Charles for a very clear paper and presentation. And maybe one personal remark, which I find really important and interesting, is that starting from a seemingly standard data set, but by understanding the specificity of the microstructure and developing a new algo, you extract new features which shed a new light on the market structure. And that's also part of what we call alternative data. It's not necessarily going for brand new data set. It's also a new feature extraction from good old data set, which help us understand what happened. So regarding retail trading, my first naive reaction at the beginning of the year is that, well, it's an internet bubble once again. I mean, people going to the office and looking at the stock portfolio and betting on internet stocks, and what's the difference? And I was very naive because there's quite a significant difference in the sense that, as Ronnie, Xing, and Charles inferred to, is the capacity with social media for people to correlate or coordinate an attack or a buying on a specific stock. And that's very different from a retail flow that we notice in any kind of situation of market, can be FX, can be, as Charles mentioned, Asian market. We do face retail flow, but it's part of the ecosystem. It's uncorrelated, it brings liquidity, and it's not a risk per se. It's not good or it's not bad, it's just a different set of investors, which is part of the ecosystem. But with the meme stocks, and social media coordination, what we've seen is people really targeting specific names. And you wonder if they haven't been looking at short reporting data from the regulator to target the specific stocks and say, we want to beat Wall Street at its own game and try to crowdsource the short squeeze in many different ways. The point is that in order to have an impact or generate a short squeeze, you need to have a lot of people and a lot of volume to move the price. So you cannot do that on Apple or Facebook, essentially on big stocks. And I think that's why, Charles, you don't see that much alpha or impact of retail trader on the big names. And they are essentially having a huge impact in the small caps space. But the point is that small caps are also names which tend to be generally, if they are not startups, these are companies which are facing a difficult financial condition, which you can see in the balance sheet statement, and they are a candidate for short sellings. When you are a hedge fund, you see this is a company which probably can go under, so I want to short it and arbitrage this effect. So a lot of people, and more precisely people which are very correlated, discretionary short seller or long short hook, will tend to focus on this name and can build huge position on these given names. And if ever it becomes one of the meme stocks, you get a perfect storm for this type of investors. For us personally, we didn't notice the GameStops and the like actually at the beginning of the year, because we were more in the highly liquid space, and it was more like volatility induced and brokers saying, are you facing difficulty or the like, to give you an idea. But if you're extremely focused on a specific small portfolio, you can get impacted. The danger for us is that if a specific fund, an asset manager or hedge fund, gets hit by such type of event, as in the financial crisis, it can produce some kind of snowball effect, because they might be forced to liquidate their book because of margin call. If they liquidate their book and their book is a little bit correlated with another manager, so on and so forth, and we get a kind of difficult event. So that's why we also had to essentially monitor this brand new risk factor, which is nowadays fashionable across quants and banks and broker, which is identifying this Reddit or Wall Street bet type of names. And as Ronnie inferred, you have to essentially scrap all the social media and try to, using an LP or the simpler technique, try to assess which are the names which are getting popular, having a very dynamical risk factor that pops up and can disappear as fast as it appears, and make sure that your portfolio is not exposed or sensitive to this kind of brand new risk. And we're not alone to do that. Also, the central counterparties in the business, which are catering to asset manager and providing leverage to all of this arbitrageur, are also doing that because they know that they can be badly hit with such events. So that's a little bit what I wanted to share with you today, but happy to have any question from the panel or the audience.
Thank you, Laurent. I was checking, the audience seems to be very quiet about at least what I have here. I have only 2 questions, and they don't refer to any substantive theme. So maybe I'll start with another question myself. So that will be, and I think it's for all of you, but it was both Ronnie and Laurent mentioned it explicitly, which is this connection between stocks, which are maybe for natural reason highly shorted, and the stocks that become meme stocks. So in creating this new risk. The question is, what comes first? That is, are those people just looking at short positions and say, oh, that's the time for us to get together? Or just that people short stocks without looking at the signals that Laurent mentioned?
Well, that's
Both you and Ronnie mentioned. So I start with Laurent for that one.
yeah, that's a chicken and egg problem. I think in the case of GameStop, it was definitely a highly shorted name. When you look at the hard to borrow cost and the short reporting, you see that it was heavily shorted, and probably some of these guys decided, so we like the shop, it's we want to do something, and let's crowd it and try to short squeeze. But is this a generic situation or just a one-off? Frankly, I would say it's very difficult to assess. The next one, is it a cryptocurrency? Is it a new ETF? Is it a new commodity or whatever? We don't know what it will be, but definitely we can expect pocket of such activity here and there with the connectivity that social networks are bringing to coordinated investors.
Oh, great. Ronnie, do you have anything to add to this?
I think Laurent was right that the GMA stock is certainly, fund managers were short this stock for a long time. But what happened mid-January, there was an announcement of something, and I forget what the CEO said, that we're changing something like that. Then it got on the radar that the stock is targeted by short sellers. And that's when retail investors said, oh, we're against this hedge fund manager. We don't want him to profit. Rocket, rocket, rocket. So that's the series of events in the GME. But now I think you might be right. There's something different might be going on, because I see the stocks that are heavily shorted. And some of them, there's some social media discussion about them. So it might be that it's going to create some kind of an equilibrium where when you try to go short and suddenly it picks up on retailers' radar, and then you start this war. It used to be a war between CEOs and short sellers. That's what it used to be. Somehow now, the CEOs are bringing in retailers, on their side, and they're essentially. I mean, it's the same thing with AMC, right? They're bringing the retailers, and they told them, well, if you show us what the AMC CEO said, right? If you show us that you're buying the stock, you get like free popcorn or something. I mean, so they're really trying to use retail investors on their side. Yeah. So I think, again, if you're a large institutional manager, you just have to monitor that discussion and try to avoid it. Because even if you're going to be sometimes in the long, that's, that spike in volatility for your fund, if you did 20% or 100% in January, that's great, but you should close, because no one is going to invest. It's going to be hard to justify it, because investors can say, what would have happened if you were on the upper, on the short side.
Okay, Ronnie, thank you. This is great. Actually, this question, I think Charles could contribute to it, but in a slightly different manner. And picking up on a question that was sent from the audience, is there any regulation needed for this kind of situation? And Charles has thought a lot about regulation.
Just to clarify, Jose, are you talking about short squeezes or retail trading?
What goes on in short squeezes, the retail trading, there seems to be, let me just elaborate a little bit. So a lot of this short squeezes are happening. There's also participation of some big traders, like the Tesla guy, for instance, he comes in and says, the stock is great, AMC is going to open, if you buy a Tesla, we're going to give you an AMC theater or something like this, that I will buy from them. Whatever it is, there seems to be a big asymmetry between what you can say bad about a company and what you can say good. There's much more regulation about what bad things you can say about a company. So that's what kind of thing that I think regulators should worry about, whether the asymmetry is justified.
Yes, I think that's right. My sense is that symmetry is good, that we need pessimists and optimists to be in the market in about the same way. So I think if, as long as our regulations are symmetric about what you can say positive and what you can say negative, that's probably the right way to approach it. Unless there's some sort of big difference in market power on the two sides. So if you have a few very large shorts and they have outsized market power, then maybe regulatory limits make sense. But otherwise, I think that symmetry is what we should be aiming for, because otherwise we're disadvantaging the pessimists, for instance. And I don't think that's a good idea, because really we want prices to be right. We don't want them to be too low and we don't want them to be too high. And so getting that balance right is really always the challenge. So that would be my high level comment on that.
Thank you, Charles. So let me get to another question that came from an anonymous attendee. But it's an interesting question. So have any of you looked at any correlations or any causality between the stimulus checks and retail activity? Anybody can take that question. That if, the researchers mainly, have looked at this connection between the distribution of stimulus checks and retail activity.
So maybe I can start out with this one.
Sure, that would be good.
We didn't put that in the paper, but we did look at some of the how the retail volume of Robinhood relates to the stimulus check. We did have like some graphs, which you can see when the stimulus check come out, you see some spike of the retail Robinhood trading volume. So some people, when they get the checks, maybe they start trading more. And there is a significant spike even just on the daily level. So we do see that. We didn't really look at like the cross-sectional heterogeneity across the stocks, but I would suspect some Robinhood popular stocks will get more trading volume on those days.
And also, since Robinhood investors have a strong long bias, they tend not to short nearly as much. These stimulus checks would lead to Robinhood buying in general. So I would guess that's going to lead to price rises and maybe your reversals afterwards, but it's going to start out being price rises from the buys that Robinhood investors are going to undertake in response to the stimulus checks.
Actually, that's an interesting question for an economist. Of course, everybody would like, in terms of activity, general economic activity, is that the stimulus check be all spent. But we know from past experience that that's not a realizable goal, that some of it will be saved. And I would expect that Robinhood investors, their form of savings, buying more of their stocks, right? So I wouldn't be surprised that the question is whether this was inordinate this time, that we had a much bigger amount than in other previous episodes of stimulus checks.
So I don't know how the marginal propensity to consume would be in these checks versus others, but these were sizable checks. So I think the dollar amount of the activity would be pretty large. So, and I think even if you had MPCs that were similar to previous checks, that you'd actually get more economic activity out of them.
Just because of the size.
Yeah,
right?
the size was large and pretty quick. So
yeah,
we moved a lot faster than I think anybody expected on that.
So,
so Jose, I think we need to start wrapping up. So maybe one last question.
Okay. So I don't see any questions from the audience. This sounds like a shy audience. It's almost what I normally call an European audience, because Europeans ask much fewer questions when you give a lecture than the Americans do. But in this, we talked already about regulation, and we talked about the questions of shorting. So for last theme, I would like the panelists to give me like a 1 minute statement about what do you think we've learned from this episode. What is the things that we have to do both on our research and also as investors, but a very short answer. I'll start with Charles.
So I think that these retail investors are obviously much more important than they were even just 2 or 3 years ago. So I think the more we focus our research on what they're actually doing, I think the more we're going to learn. So I think this is a permanent change, I think, in their activity level and a permanent shift in the kind of activity, the rise of Robinhood and these kinds of retail-oriented brokerages that are targeting younger investors. So I think that those changes are permanent, and really we should focus our research on them in a way that we haven't really yet. It's starting to happen, but I think it should continue to happen.
Thank you, Charles. Xing, very short statement again.
Great, thank you. So because my research area is in retail investors, of course, I think they are quite important. And I do think there are a lot of changes happening in recent years. And especially, I think there are a lot of coordinated systems which will create this kind of systematic behavior across retail investors, which will amplify their effect, which we didn't understand very well in the past. And one thing I wanted to ask, I know like we're running out of time. I wonder like for the institutional investors, because it's very hard for them to coordinate short selling. So they may actually enter the buy side, which will keep amplifying the bubble as well. And that may also increase the cost for the short selling.
Thank you.
Also play out
Shane.
like, in the whole process.
Thank you,
Yes,
Shane.
thank you.
Ronnie?
I agree with Charles and what you said before. We need to understand better retail trading through communication social platforms. We need to develop the tools for investors to understand it and maybe better prepare for the risk of squeezes in the future.
Thank you, Ronnie. Laurent, you get the last word.
Thank you.
Before Harrison.
Yeah, for me, I think we knew that there was crowding risk among asset manager or institutional manager, and it exists, and we're trying to mitigate it. What is new with retail is that we always thought that retail was a kind of random sea of liquidity mitigating foreign. The brand new thing is that now they can coordinate and becoming a source also of crowded risk. And I would be really interested to have more metric about this risk, the connectivity of traders, of retail traders. Is that one source, many sources, and how we can pay attention to them, because there's much less reporting information about them. We have to rely to subtle data analysis to try to extract their behavior. And I think that that's a really important research stream going forward to understand the market structure.
Thank you, Laurent. Harrison.
Great. Thanks, Justin. Thanks so much for moderating a great panel. Thanks again to everyone. I learned a lot. So I think, we have like about a minute left. So I'm going to just close out and just thank everyone again, and stay tuned for the next session. There were some questions in the Q&A about whether the recordings would be posted. I think they should be posted in one of our YouTube channels or on the website. Otherwise, have a great afternoon, everyone. Bye.
Thank you.
Thank you, guys.
Thank you.
Thank you.
Thank you.
Bye.
Thank you. Bye-bye.